Not quite when it comes to the equity markets. In fact, anything but, because sentiment has certainly soured across the board when it comes to different asset classes, in particular with the rising tensions between Israel and Hamas. So just to put things into perspective, let's just take a look as to what the 1 week of the geopolitical strife and the impact of the geopolitical tensions have had on different asset classes. For instance, we've seen a spike in crude oil prices that has been quite significant, to say the least. You had them seeing quite a rally on Friday's session, and that did manage to reverse. And you did have a fresh blow as well being dealt to the global economy on the back of all of that news. Gold prices, for instance, as well have spiked about 5% to about $1,926 per ounce. You've also got the emerging markets, MSCI emerging markets, the CBOE volatility index, and the dollar index as well, seeing some sort of a move. So Nikunj as well joining in on the show. And morning, Nikunj. Clearly, we're looking at the overall impact of the geopolitical tensions across asset classes.
See, Avan, look, what are the headlines? The headlines clearly are something which are not really very kind in nature. Bloodshed, destruction, no truce, no evidence of any kind of a ceasefire. So news, at least from on the geopolitical front for next couple of days, who knows, it could be weeks or months also, is not going to be market supporting. But the point you would ask yourself is that how much of this geopolitical tension will have a cascading impact on the financial market per se, on the commodity prices, the supply chain, and how things on the economic frontier will move. I continue to maintain that you will see spikes and you will see reactions in asset classes, but they will not be scary. The upticks and the downticks, I think the upticks would be very measured. This is not Russia and Ukraine where it was a war between two countries. It is something which changed the entire geopolitical landscape. It had far-reaching impact on energy. It had far-reaching impacts on the yields and the underlying risk premium. There are three things which matter. Cost of energy, which in the near term will be hard to call. Impact on yields. One looks at the 10-year paper and the global bond yields, they've not really shot up. And third, the geopolitical, third, the risk premium and the volatility index, which is CBOE VIX, which is still south of 20. So global financial markets are clearly messaging very simple that yes, this is something which markets are not very happy about, but markets are also not very scared about. So the best strategy in this market, if you're watching the show, I guess is simple. Stay long in the market. You got to be a buyer on the bad days, and just don't go short because there are geopolitical problems somewhere in the world. I think the approach for a day trader and for a positional trader is stay long, buy the dip, and don't go short.
Okay, stay long, buy the dip, and do not short in a hurry. That's the messaging, and that's exactly what we have been doing for last week as well, because Nifty has managed to gain for a second consecutive week. If you look at the last week performance, in fact, it was the highest gains that we have seen in the matter of 4 weeks already. Real estate pack that continues to build on gains. So Nifty Realty Index was sitting at record high level, and solid moves across the board is what we witnessed in the week gone by. Having said that, it seems like there's some profit booking which is underway when it comes to the PSU banking space. So that was the top sectoral loser. And Nifty Bank, that has been falling for the 4th consecutive week. And the question is, Nikunj, when will Nifty Bank come to participate? Because whether it's heavyweight, HDFC Bank, ICICI Bank, or the rest, they have been weak in the week. They have been on the back foot in the week gone by. Though autos and realty started making a bit of a comeback.
I'm reading the CLSA India strategy note, and the second para of this is that the non-India dedicated funds, which is for institutional investors, they're selling India and they're reducing their exposure to India. And FIs have cut their overweight in financials by 10 bips to an all-time low of 5.5. So they've cut their positions in financials largely because of compulsive selling which they have. So I think financials are going through a patch of compulsion rather than a patch of derating. Yes, 2022 was a big comeback year for banks, but 2023 has been a quiet year. And stocks can consolidate, and I think that is what the consolidation, and that is what we are currently going through. I don't see too many fault lines in the numbers. I know a lot of brokerages have come out with their assessment on SBI and other financials that they are expensive, but I beg to differ. For me, yes, the earning expansion, the credit expansion cycle is not over. NPAs are under control. Interest rates are likely to move higher. Of course, the peak profitability in terms of percentage will not be as strong as what we saw in FY23. But given where the growth, the visibility, the ownership is, and the profit of valuations is, I think financials will make a comeback. I mean, it's a matter of days or weeks. I don't know. It could be after the earnings season or it could be next calendar year. But I'm ready to stick my neck out and say that financials is where you want to be in. You want to be in financials, first, private banks as a contra call if you're looking at a theme-based investing. Then look at NBFCs which have a large wholesale book because NBFC interest rates are coming down. And see, I will not be surprised that given what we are getting from some of the AMCs and insurance stocks also, they will come back with a laggard. But I think they are also looking good for some cherry picking.
Okay, sticking your neck out and saying that financials, in particular the private banks, are good for an opportunity. Speaking of private banks, it is going to be all eyes reined in on HDFC Bank because you have the combined entity for the first time that will be delivering their numbers today. And we're going in with expectations that the profit could come in at around 14,800 crore rupees. Of course, we'll be watching out for the monitorables on their overall margins, the net interest margin trajectory, loan and deposit growth, as well as asset quality. But that's not the only thing we'll be watching out for. It's a very busy week. You've got big numbers, the likes of Bajaj Finance. We'll be watching out for Bajaj Auto, Ultratech Cement, HUL, ITC, both coming out on the 19th of October. And then there's also the likes of a geo-financial, Nikunj, Paytm, Tata Communications. So take your pick. Everything's going to be closely monitored.
Okay, so the interesting bit for me would be FMCG, and it's like the most under talked about and the most disregarded sector, but purely looking at what the moving part for the quarter gone by was, the moving part for the quarter gone by was change in commodity prices and some kind of in volume outlook, which I think you will get from, let's say, companies like HUL and ITC. ITC after that hurrah at the in the mid part of the year has flattened out. HUL has done nothing. So if you're looking at a large commentary which I think should come from a particular sector, I think it would be a combination of Nestle, HUL and ITC. IT we've already heard. Bank, there's nothing dismissive, which is the third big sector. Then you left with autos and to some extent consumer. And consumer staple is where you are likely to get a sense this week. I think Paytm numbers would also be crucial, even though markets know that the trajectory is going to be important. They've shared enough and more in terms of forward guidance. So nothing specific is expected from Paytm per se, at least in this week. But in terms of a tone and tonality and the set tone of the communication, I think it really would be consumer staples as a category or as a cluster.